Hi there, and welcome to Red Spark's Crypto Blog, a place for all things blockchain, crypto, and my favorite coin, Cardano. Today's video is about crypto in general and aimed at beginners, those who are inquisitive about the crypto markets but don't know where to start. Now, it's a bit of a long video by YouTube standards, so I will add timestamps down below. However, each point does flow on from the prior point. If you prefer, you can also read the text version on my blog, redspark.blog. Quick shout out to Robot Stake Pool, an environmentally focused Cardano stake pool. Feel free to read more on robotpool.blog. However, this video is not about Cardano, so let's get going. 6 things every muggle should know about crypto. I often get asked by friends and family about crypto, and I always say to them that I'd rather not advise on whether or not crypto is a good investment, but simply that there is a lot happening out there that I think people should at least be informed about. That is all. My reticence to talk about crypto is based on my view that there are certain fundamental points, some of which are less related to crypto and more related to macroeconomics, that people should understand first before they dive into the world of cryptocurrencies. But I would always struggle to find a good link I could refer them to that had all that fundamental knowledge in one place. So, on that note, I thought I'd put together a comprehensive guide to everything I've learned in my last 2 years in crypto that have shaped my views. Consider these to be my aha moments. But I emphasize that I'm not intending this to be an argument for or against crypto. If anything, this is an argument for staying informed. Point 1. Investing is the vehicle for changing your life. My goal when I started investing in stocks and later crypto was to scrape together enough for a down payment on an apartment. Prior to this, I was trying to save up, and due to living in an expensive city, I calculated it would take me many years to get to the point where I could afford even a one bed apartment in an okayish neighborhood. I looked enviously at some of my peers who have been smart enough to start investing since college, or university as we say in the UK. And that's the message we hear growing up, that we should get ourselves a savings account and start building up a nest egg. We tend to see saving as a low risk option. We might not earn much, but we're not losing our money either. Savings account used to give 4 to 6% interest. However, these days, with interest rates historically low, it's more like 0.5%. We'll talk more about the true cost of saving in the next section, but suffice to say, saving is a way of staying where you are. If I had continued to save, I would eventually have enough for a down payment, but I'd be many years down the line, and with a mortgage, I'd be tying myself up in lifelong debt. As the saying goes, the poor spend, the middle class save, and the wealthy invest. It's a bit of a patronizing sentence, but getting to its core, it's saying that the only way to really change your life from a financial perspective is to invest. It is how the rich get richer and widen the gap between them and the rest of society. Investing could be in stocks, gold, property, crypto, bonds, or something else. I started off in stock market trading, but then got into cryptocurrencies. Stocks and crypto can be riskier in the short term, but tend to offer better returns in the long term. And so the ability to stomach the dips is important. And it's easier to stomach the dips when you have a greater financial cushion. Crypto markets are highly volatile, and the first 3 months or 6 months of investing in crypto can be the most stressful. But I found that as my financial cushion grew, investing became less stressful, which in turn allowed me to invest more. I'd rephrase the old adage that it takes money to make money to it takes money to take risks with money. Now, let me say that this is all under the context of a market that is trending upwards. Stock markets and other markets tend to offer better returns than cash in the long term, but a lot of them have peaks and troughs along the way, known as a bull market when going up and the bear market when going down. And each of these cycles then have their own peaks and dips, which present good buying or selling opportunities to the savvy. As I'm not a financial advisor, I won't go into this further, though we will cover the Bitcoin cycle theory at the end of this blog post. But my main point here is that it was a mindset change for me to realize that in general, saving keeps you as you are, and investing is a vehicle to better your life. Point 2. If you keep cash in the bank, you are in fact losing money. When it comes to investing, a lot of people shy away from it as it seems complicated. You have to make a decision on what the right asset to invest in is, and everybody has competing views. You're just an ordinary Joe or Jane, you don't want to be dealing with all of that. Best just to keep the cash in your bank account, right? Sadly, and in the words of one of my favorite movies, Rocky 4, there's no easy way out. There's no shortcut home. Regardless of one's desire not to have to think about these things, leaving cash in the bank is actually you making an investment decision, and not necessarily a great one at that. And that's because of inflation. Yeah, we all know that inflation is what makes prices go up. And if our salaries only go up in line with inflation, then our pay has really just stayed the same. That's about the extent of most people's thoughts about inflation. But what inflation really symbolizes is a decreasing value of your cash relative to everything else around it. In other words, if you hold on to your cash for too long, it will be worth less and less as everything you might want to buy with it houses, cars, gas, price of food, vacations get more and more expensive. Now, in a good year, a modest amount of inflation is desired by central banks, and they try and influence it through interest rates and other mechanisms. The system is designed to discourage you from hoarding cash and encourage you to either spend or invest. This is why it's generally better to invest in something than watching your cash decrease in value over time. But we're not in a good year. We're in an extraordinary year in which central banks have injected tons of surplus cash into the monetary system. They've tried to pretend that this wasn't causing inflation to go up even faster, but recently they've started having to backtrack on that, as evidence is coming in that shows inflation is rising rapidly, with some commentators saying that the real inflation is running at 12%. Central banks are caught in a quandary. They could raise interest rates, in which case you start to see slightly better returns on leaving cash in the bank, but that could have other negative ramifications for a fragile economy. So everyone is watching to see what central banks do and how the markets then react. From my non financial advisor point of view, it seems cash is like ice cubes, and it's better to reinvest in something gold, stocks, property, crypto, anything than continue to watch it melt. That being said, there is one situation where cash is king, and that's when stock markets crash. In this case, cash is worth more against stock. Against gold, less so. Gold is seen as a traditional safe haven if stock markets crash. Property, that's a safe place too, as you may have heard about in the news, unless, of course, there's a housing market crash too, which could be caused by central banks raising interest rates because of inflation, which then leads to more people defaulting on their mortgages. But as I said, I am not a financial advisor. As for crypto, well, some say cryptocurrency such as Bitcoin is an alternative to gold, a safety asset to turn to if stock markets crash or due to fears of inflation. There is only a finite amount of Bitcoin, 21 million, that will ever get created after all. But I feel it's got its own unique properties. Crypto would likely crash if there's any panic in the stock market, but it then does tend to rebound quicker. The main point I'm making here is that we should all at least be aware of the decreasing value of cash over time and how we can try and retain monetary value through investing rather than saving, regardless of the choice of investing vehicle we decide to use. Point 3. Market value does not have to match intrinsic value. How do you determine the monetary value of a company or even a house? There are several ways financial analysts and realtors use to answer this, but really only one of them is ultimately right, and that is it's the amount that someone is willing to pay for it, also known as the market value. There is also a notion of intrinsic value, or to put it simply, what we think something is really worth if we are being rational. For companies, for example, that can be calculated by looking at what we think the future profits of the company might be and then determining the value of that in today's terms, known as the DCF method. In a rational world, you'd expect market value and intrinsic value to be the same. After all, who would pay more for a company than what analysts think it's worth? Or inversely, why would sellers sell for a price less than what something is worth? But this is very common in both financial and housing markets. And this difference comes down to macroeconomic factors and individual needs at the time. The chart below shows the average market price, the top line, versus the average calculated intrinsic price, the bottom line, for the London Stock Exchange, taken from research by Caravias, Biliotti, and Savalis. Here we see the market price was consistently above the intrinsic price even during the financial crisis of 2008. The gap can be attributed to sentiment, and it can widen or decrease over time. So, what's the connection to crypto here? Well, when thinking about crypto, there is a great debate about how much of it is driven by sentiment versus intrinsic value. In my mind, it depends on which type of coin we are talking about. I would argue that coins solving real world issues definitely have intrinsic value, whereas coins such as Bitcoin are more driven by sentiment. But that sentiment is driven by mathematics, as we will discuss next. Point 4. Crypto is all speculation and it has no inherent value or use case. This is a sweeping statement made by those that don't really understand crypto. It's an easy one to make. Here is what such a person knows. Bitcoin was a bubble a few years back. There was immense hype, and then it crashed, and a lot of people lost their money. Cryptocurrencies are digital coins made out of thin air on computers. There's no inherent value. These two facts is what gives rise to the idea that crypto is all speculation and gambling. Sure, you can make a lot of money, just like you can go to Vegas and make a lot of money. This, however, is too simplistic an argument to make. There are certainly a lot of crypto projects that do fall under this view of gambling, but they tend to be smaller cap coins. Let's instead take a look at some of the bigger projects. Bitcoin. Imagine a dripping water faucet, or tap as we say in the UK, that keeps dripping water. Drip, 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 at a steady, constant rate every 10 minutes. To begin with, it's dripping big globules of water each time, and tiny people down in the sink basin are collecting up these drops of water and trying to convince others to bite off them. Naturally, some people are excited by this magical water that comes from nowhere, but others aren't. So there's some demand which ebbs and flows. It might get popular for a little while, but then it might die down. But after a set amount of time, 4 years to be precise, an invisible hand that nobody controls turns the tap by half, resulting in the size of each drop of water being reduced by half. And after another 4 years, the tap turns by half yet again, and the drops reduce in size by half yet again. And this process repeats every 4 years. So the interesting question is this: what would we expect to happen to that natural ebb and flow in the market for these water droplets down in the basin as the supply steadily dries up? Now, in this bizarre metaphor of mine, the water droplets represent obviously a certain amount of Bitcoin being produced. Bitcoin is produced every 10 minutes, and the amount produced decreases by half every 4 years, thanks to the inbuilt mathematical algorithm of Bitcoin. So, on the one hand, Bitcoin is this magical internet money that's being produced out of thin air, or rather by this mathematical faucet. But on the other hand, it's becoming harder and harder to come by. So, really, the Bitcoin price is a battle between what dries up faster: interest in Bitcoin versus the availability of Bitcoin. Well, we don't have to wonder about this too much. We can actually see it in action in what is possibly the greatest chart of all time. This chart shows the price of Bitcoin, with each green or red bar representing the monthly price. And as it's a logarithmic scale, don't be fooled by the bars on the right. They are the same size or even greater than the bars on the left. Each blue vertical line represents the moment the Bitcoin tap got turned by half and the supply reduced. This chart spans the years 2012 through to the middle of 2021. And looking across the chart, each strong upward green bar represents immense optimism and hype around Bitcoin. CNBC reports, your friends talking about something going to the moon, and all that hoopla. And each red bar represents the end of the world for Bitcoin. I was a fool to buy it. It's all gambling. It's a scam. Get out, get out, get out. But you see, the mathematics does not care about these micro movements. The only thing that matters is what dries up faster, interest in Bitcoin or the supply of Bitcoin. That's the question we should be asking. And according to this chart, it's the latter. Interest in Bitcoin could wane for a variety of reasons. Governments could ban it or regulate against it. There could be a debate over its energy use, and other cryptocurrencies could become more popular and so on. So it's not necessarily a slam dunk that this chart will go up forever. But at least take a moment to appreciate the beauty of this chart. Mathematics at the macro level and human greed and fear at the micro level. Now, let's combine this thought with what we said earlier about inflation. When you are trying to find an asset to store your monetary value in, or monetary energy, as Michael Saylor likes to say, so that it retains its value many years into the future, do you invest in company stocks, where you are placing a bet on the future success and growth of specific companies? Index funds that track the stock market, where you're not having to pick the right stocks, so as long as the economy does well and doesn't enter a recession, then your portfolio should do well. Property, which has been going up rapidly in recent times but could potentially have a correction in the future. Gold, where the price now is slightly higher than it was 10 years ago, and it had dipped in the intervening years before recovering. But it does get harder and harder to mine, which makes it scarce, although we don't know what the true limit of gold is. And it has been valued by humanity for a very long time. Cash, where we know it naturally decreases in value over time relative to these other assets, and even more so these days due to money printing, but might be a good bet in times of uncertainty. Or Bitcoin, this mathematical faucet, which we know has a maximum limit of 21 million coins, and we know that it'll get harder and harder to come by in the future. Now, there's no right or wrong answer here, and there are other types of assets I have not mentioned, such as bonds, but I'm not a financial advisor. Although I'm sure they'd say a good approach is to diversify your portfolio across a number of the above asset classes. The point is, investing does require comparing asset classes against one another and making these investment choices. Bitcoin and some other deflationary cryptocurrencies do offer something that's hard to come by with some of these other asset classes, and that is certainty. There is certainty about how much Bitcoin there is, how much there ever will be, and the rate at which it will get produced. Certainty that the supply of Bitcoin isn't swayed by a political agenda, a coin can't be changed like you can with stock splits, more can't be produced by central banks like you can with cash. Bitcoin has certainty almost everywhere except for the market sentiment. And as the chart earlier suggested, that does not appear to be waning as fast as the supply is shrinking. There are other types of coins beyond Bitcoin, though Bitcoin is by far the most popular. All these other coins are collectively known as altcoins. We will discuss some of these coins next. Smart contract coins. The second type of coin to be aware of are smart contract coins. Smart contract coins allow for business logic to be codified and executed without the need for a central authority. So, for example, imagine you have this amazing invention and you want to sell the patent for it to a mysterious buyer. The buyer is saying they'll give you $1 million if you hand over the patent, and you are saying you'll hand over the patent if they first hand over the $1 million. How do you resolve this standoff? Chances are you'll resort to some middleman that both parties trust, like a lawyer. Well, with smart contracts, that middleman is code that automatically executes. No one can change the code, no one can stop the code. Once you've initiated it, it will do whatever it's been programmed to do. So, in this case, if the patent itself was first digitized as something called a non fungible token or NFT, which I'll have to cover in another video, then a smart contract could be set up to execute once you have deposited the NFT for the patent into the smart contract and the buyer has deposited $1 million, also digitized as a stable coin, which we'll come on to shortly. And once a smart contract has both of these, it can automatically perform the role of virtual middleman and do the exchange. Imagine buying or selling stocks without the need to go through a broker. Imagine millions of dollars being exchanged every day in this manner. Sounds far fetched? Well, that is exactly what the Uniswap coin that is built on top of the Ethereum cryptocurrency is doing every day when it allows people to trade coins with each other. It behaves as a cryptocurrency exchange, but without any central authority running the exchange. Hence, it is known as a decentralized exchange or DEX. And yes, you heard me right. This is one cryptocurrency, Uniswap, that is built on top of another cryptocurrency, Ethereum, for the purpose of trading other cryptocurrencies. Ethereum can be considered the smart contract platform and currently the most popular one, and Uniswap is a dApp, a decentralized application built on top of it. And it's just one example of the innovation taking place. Borrowing and lending, derivatives trading, trusted information sources, it's all being reinvented in a world where there is no middleman, and it's progressing at a faster pace than you can imagine. Decentralized finance, or DeFi as it's known, is a booming area of innovation that threatens to disrupt the finance industry. And these decentralized applications are not restricted to finance either. You just have to go to the State of the dApps website to see all the different categories that people are innovating in. I'll also give a quick shout out to my personal favorite coin, Cardano, which is due to become a fully fledged smart contract platform in September of 2021. There is already a project underway to store educational records of students in Ethiopia on the Cardano blockchain. And there was also a pilot project in the food supply chain sector for both beef and wine. VeChain is also another coin in the smart contract category that deserves a mention. It has numerous real world projects that they can point to, with partnerships with companies such as Walmart in China. All this goes to show that cryptocurrencies are not just about DeFi applications. They are being used to drive blockchain based innovation across traditional enterprises. Now, as stated up front, I am not saying that you should invest in or not invest in these types of coins. A lot of them are high risk. I'm simply saying that there's a genuine use case for cryptocurrencies driving tangible value today. I feel like investing in these altcoins is not too dissimilar to investing in early stage startups. There are hundreds of altcoins all competing with one another. Some of them are scams, so you do need to watch out for rug pulls, which is when they mysteriously disappear. But the three that I've mentioned here are genuine projects that are worth looking into, and they're by no means the only ones. If you are going to invest in altcoins, then as we say in crypto, DYOR, do your own research. Stablecoins. These are coins that are pegged to a real world currency, usually the dollar. USDT and USDC are the two most popular ones. One USDT or one USDC always equal $1. And they don't do anything smart either. So what's the point of them if they never change, I hear you ask? Why not just keep US dollars? Well, the main reason is that as they are a digital version of the dollar, you can build smart contract platforms to interact with them automatically. Doing the same with real US dollars would be cumbersome. But going back to what I was saying about savings accounts and how they offer a measly 0.5% interest. Well, with crypto savings accounts such as BlockFi and Nexo, you could be earning around 8% or more interest on your stablecoins. Let me rephrase that. You can convert your US dollars into a digital US dollar, a stablecoin that never loses its value, and you could be earning around 8% interest on that. Sounds crazy, huh? I won't go into the detail on how they can afford such high interest rates, but it's to do with the whole lending and borrowing ecology that exists out there in the DeFi space and you being a liquidity provider. CBDCs. Central banks have realized the benefits of having a digital programmable coin that is pegged to a national currency, and countries all over are now considering introducing their own central bank digital coins, CBDCs, with China already having introduced one. This would allow them to have a super tight control over the monetary system and have greater levers to pull when looking to influence the economy. This can, of course, lead to infringements on our privacy and liberty if not implemented correctly. To conclude this section, cryptocurrencies have a range of different use cases, and we've covered a lot of them. Yet the majority of people are oblivious to all that is going on. Point 5. Financial institutions, companies, and even countries have cautiously started getting into crypto. Previously, we asked the question of whether interest in crypto, and Bitcoin in particular, as that is the most popular coin by far and a bellwether for the entire crypto industry, is waning over time. Well, what seems to be happening is the opposite. A lot of financial institutions, companies, and even governments are starting to adopt crypto, albeit cautiously. We'll go through each one in turn, but let's start off with some statistics to help set the backdrop. Research by People Say showed that 88% of all investment in cryptocurrencies is done by respondents with a college or a master's degree. And when it comes to generational breakdown, 38% of Gen Xers, 49% of Gen Y, aka millennials, and 13% of Gen Zers own crypto. And that of these groups, the percentage that were very likely to purchase products or services using cryptocurrencies was 40% for Gen Xers, 53% for millennials, and 7% for Gen Zers. What I take away from this is that those in their prime earning years, millennials and Gen Xers, are the ones investing in crypto, and Gen Zers will probably soon follow. It's against this backdrop that financial leaders that may have been skeptical about Bitcoin, most famously Jamie Dimon, CEO of JP Morgan, are coming to the realization that it cannot be ignored. So let's do a quick tour of these financial institutions. Hedge funds. According to a Financial Times article, a survey of 100 hedge fund chief financial officers globally found that executives expect to hold an average of 7.2% of their assets in cryptocurrencies in 5 years' time. Asset management. There are already a lot of digital asset management funds that are heavily invested in crypto, with the five largest of these holding over $46 billion in crypto. In addition, more traditional funds, such as world's largest asset manager, BlackRock, has started exploring crypto. Vanguard, however, so far has a skeptical view of crypto, stating, "The fact that cryptocurrencies are not issued by a central bank is actually the very reason why they can't achieve the quality of other well accepted currencies. The role of a central bank is precisely to preserve the value of the currency by keeping inflation under control. That's why prices are more predictable under Federal Reserve management of the US dollar money supply. Time will tell if they change their stance on this." Fidelity is perhaps the most bullish of traditional asset management firms, having launched Fidelity Digital Assets in 2018, offering both custody and trade execution services, as well as mining its own crypto. It's also planning on launching its own Bitcoin fund. Banks. Let's start by acknowledging that Chinese banks make up the biggest banks in the world and they are banned from providing cryptocurrency services. However, at the same time, the Chinese government is pursuing the creation of its own cryptocurrency, the digital yuan, so this ban should be seen against the backdrop of China wishing to have total control over its monetary system. The US bank's attitude to crypto can be summed up by these two quotes from Jamie Dimon. A lot of our clients are asking, can we help them buy or sell cryptocurrency? And we're investing in that as we speak. Jamie Dimon, May 18th. My own personal advice to people is stay away from it. That does not mean the clients don't want it. This goes back to how you have to run a business. I don't smoke marijuana, but if you make it nationally legal, I'm not going to stop our people from banking it. Jamie Dimon, May 27th. JP Morgan is launching a Bitcoin fund this summer. Its competitor Citigroup is considering something similar. Bank of America is perhaps the most skeptical and dismisses Bitcoin but sees DeFi as intriguing. Goldman Sachs has started trading Bitcoin, and Morgan Stanley already has a Bitcoin fund. These US banks were buoyed recently from regulators announcing that banks can provide cryptocurrency custody services to its customers, as well as the fact that the SEC does not consider addressing cryptocurrencies as a priority for 2021. For all intents and purposes, it seems US regulators do not wish to stifle financial innovation that could see the US leading the world, just like it did with the rise of the internet. Public companies. Tesla and Square both famously hold Bitcoin, but the most famous public company to own Bitcoin is unquestionably MicroStrategy with its mega bullish CEO, Michael Saylor. Just watch this.
If I told you I know how it all ends, right? Once you know how it all ends, that the only use of time is how do I buy more Bitcoin? But take all your money, buy Bitcoin, then take all your time, figure out how to borrow more money to buy more Bitcoin, then take all your time and figure out what you can sell to buy Bitcoin. And if you absolutely love the thing that you don't want to sell it, go mortgage your house and buy Bitcoin with it. And if you've got a business that you love because your family works for the business, it's in your family for 37 years, and you can't bear to sell it, mortgage it, finance it, and convert the proceeds into the hardest money on earth, which is Bitcoin.
Pretty bullish, I'm sure you'd agree. Now, a strong argument made by Michael Saylor, who did not pay much attention to Bitcoin until the COVID crisis, is that options for companies wishing to preserve their wealth is limited. As mentioned earlier, trying to decide what type of asset to use to store monetary value is risky. But Michael Saylor is convinced Bitcoin is the pristine investment vehicle for doing so based on its 10-year historical trajectory. Governments. Finally, we come on to governments. National governments have flip-flopped over the years on their attitude to cryptocurrencies. Many have declared a ban only to quietly reverse a decision later. They are caught between one view of cryptocurrency as being used by criminals and a threat to their national currency, and another view as a new industry that's cropping up similar to the internet and that banning it would just harm their own economy. By the way, let me clarify. Bitcoin actually makes it easier for crime agencies to track criminals. Now, in June of 2021, El Salvador became the first country in the world to accept Bitcoin as a legal tender. Within days of this announcement, representatives from other countries expressed an interest in following suit. At a state level in the US, Miami has branded itself as a pro crypto city, and Texas and Wyoming are pro crypto states. Having seen how Silicon Valley grew to dominate the world, governments are understandably wary about being left behind. Point 6. Investing is all about narratives. We're nearing the end of our journey through the macro, micro, and mathematical forces that shape the crypto markets. The final section will cover some popular theories used to predict the future price of Bitcoin. But before we dive in, a word of caution. Investing, I've learned, is all about influencing the narrative. This applies to traditional stock markets as well as crypto markets. Read any analyst report or visit Seeking Alpha, and you'll see how people try to influence the market through various narratives about the stock in question. Often there is a battle for mindshare between competing narratives told by people who have a self-interest. Here are two from the crypto world. Bitcoin consumes a lot of energy and is bad for the environment, versus Bitcoin is the best incentive for switching to green energy ever created and is good for the environment. Or Ethereum transaction fees reflect its popularity and the upgrade to ETH2 will reduce these fees, versus Ethereum transaction fees are out of control and the upgrade to ETH2 is going to be slow and risk delays. I mention this as it's important to retain a healthy dose of skepticism whenever you read about an investment opportunity. With that being said, let's dive into three popular theories as to why Bitcoin and cryptocurrencies are going to the moon, to use a crypto parlance. These are a bit more substantial than the narratives above, as they are based on data, and can be considered the cornerstone of crypto enthusiasts' bullish belief about the crypto market. The network effect, aka Metcalfe's law. The network effect is the idea of the power of the network. The bigger it gets, the stronger it gets, and the more rapidly it can increase. Metcalfe's law is a quantification of that, and was originally devised as a way of valuing the telecommunications network, and states that a network's value is proportional to the square of the number of its users. It has since been used to measure the value of other networks such as Facebook and Bitcoin. This showed that over 70% of variance in Bitcoin value was explained by applying Metcalfe's law to increases in Bitcoin network size. Based on this theory, Ethereum is seen as an exciting prospect, as it has been found to be following the same pattern of network growth that Bitcoin has followed. Cardano also has a strong community and could potentially show exponential growth due to Metcalfe's law. Stock to flow, the darling of the Bitcoin world. This theory is in essence a quantification of the decreasing supply that I described through my water droplets metaphor earlier. Given that we know the rate of the decrease, we can come up with some prediction on the impact on price. The anonymous online user Plan B did exactly that when they released a Bitcoin stock to flow model and then later updated it to the STFX model. Based on this, traders predict Bitcoin to go above 100k by the end of 2021. The colors on this chart show the time left until the next halving event, with red being the furthest away and light blue being the period of the halving event. After each halving event, the shock of the decreasing supply of Bitcoin takes its time to be felt on the market price. Bitcoin cycle theory. The last theory I shall cover is one that tries to predict the price of Bitcoin in the medium term. Let's revisit our historical Bitcoin price chart. Remember, this is on a logarithmic scale. Bitcoin cycle theory states that the price of Bitcoin ebbs and flows in a cyclical fashion. After a Bitcoin halving, the vertical blue line, the supply shock of fewer Bitcoin takes around a year to work its way through the system. Essentially, there are fewer Bitcoin mining rewards to go around, and so Bitcoin miners will start to drop out of the game. Eventually, this supply shock catches up, and it leads to a new Bitcoin all-time high around a year after a halving event. In that time, there can be a false pause halfway through, where people may panic and think it's about to crash, but then it continues its upward trajectory. I've circled these moments in the chart shown. After the new all-time high, market sentiment suddenly changes and prices plummet. Years 2 and 3 after a halving is seen as the best times to accumulate Bitcoin before the next halving occurs. At the time of writing, people are waiting with bated breath. We are halfway through the bull run of 2021, and we have seen a sharp drop in Bitcoin price representing about 50% of its value. Is Bitcoin about to plummet further? Or will it follow history and resume its journey for an epic bull run and new all-time high? Only time will tell, and perhaps by the time you're listening to this, you already know. Summary. Hopefully you found this journey through crypto helpful. We've looked at why investing is a vehicle for changing one's life, and due to inflation, why it's a bad idea not to invest in something. We then explored the gap between the intrinsic value of something and its market value, as there's a debate on how much, if any, intrinsic value cryptocurrencies have and whether it matters. We then looked at some arguments for why Bitcoin and other cryptocurrencies have value, as different types of coins have different use cases. DeFi applications based on smart contract platforms in particular have the potential to disrupt traditional business models, while central banks are experimenting with their own digital coins. We also saw how financial institutions, companies, and governments were waking up and cautiously getting into crypto. There is a demographic shift towards cryptocurrencies, and no one wants to be left behind. And finally, we looked at some of the most popular narratives for why Bitcoin, seen as a bellwether for the entire crypto market, is a good investment, with a caveat that investing is full of competing narratives trying to win mindshare. I have stayed away from investment advice on crypto and therefore not covered more specific topics to think about, such as proof of work versus proof of stake, though I do cover or plan to cover some of these topics elsewhere, so definitely hit subscribe. Regardless of where you end up, I hope I've gone some way to giving you a more nuanced view of the crypto market. If you like this video and own Cardano, then please consider delegating to Robot Stake Pool, an environmentally focused stake pool with low 1.5% margin. It is by far the best way of helping me in creating new content and helps us reach our goal of getting 10 million ADA delegated. If you have no idea what I'm talking about, but like the content, then gently tap that like button, hit subscribe, and check out my blog. Thank you for listening, and I'll hopefully see you on the next video.